While on the hunt for the next great thing, financiers take on the role of venture capital firms, overvaluing fledgling firms years before they're able to generate the sort of returns that would justify the value. Sound familiar? Yes, the electric vehicle industry, which has been a popular investment destination in recent years. Investors in EV and SPACs, particularly hedge funds, have had a great run so far. There has been a rising number of new entries fighting for the stronghold, and each one looks to have a healthy valuation. In turn, this has caused concern since it's considered that the industry is experiencing a bubble. However, are investors trapped in an EV bubble? When it comes to evaluating the potential of firms, is market capitalization a useful evaluation tool? How do the Porter 5 forces evaluate the EV sector? These are the kinds of questions we'll be answering in today's video session. And to not miss out on anything, stay until the very end. Welcome back to New Vehicle Media, your go-to channel for EV stock. Quick reminder that subscribing's free and liking the video helps YouTube suggest similar content. Comments are loved and featured in our upcoming videos. In the midst of a slowing economy and concerns about the pandemic, the electric car industry is one of the few industries that has seen tremendous development in recent years. Concerns about climate change, higher pollution standards, favorable government legislation, and improvements in EV infrastructure as a result of improved technology are all driving growing demand for electric vehicles. Wall Street has been charmed by electric car stocks such as Tesla, NIO, Nikola, and Workhorse Group, as the enthusiasm around green vehicles continues to grow with each passing day. EV equities are soaring in value regardless of the fact that the whole car industry is hurting from the coronavirus outbreak. Investors are placing their bets on the future of e-mobility, which is expected to grow significantly. Tesla, NIO, and Workhorse have all seen triple-digit increases in their stock prices. To miss out on an enormous opportunity like this is something no one wants to do, and electric cars are clearly a great potential. However, fear of missing out should not force you to make an investment error. We're all familiar with the names of the main automobile manufacturers, which include names such as Ford, Toyota, and Volkswagen. The list of heavyweights is really rather short, but when combustion engine automobiles were just getting started, there were a lot more names out there competing for supremacy. What we see now are the companies who are able to survive and grow throughout the turbulent early stages of the automotive sector. Over and over again, the same pattern plays out in every sector, with a rush of early participants ultimately giving way to a small number of winners. This is a significant issue for investors. For starters, the winners may turn out to be wonderful investment prospects in the future. As a result, when new sectors emerge, there's a reasonable justification to be thrilled. Second, and probably more importantly, it may be difficult to determine which business will ultimately emerge as winners in a given market. Yahoo and AOL are two instances of internet companies that were once market leaders, but have now fallen into the ranks of the second tier. These two reasons often prompt Wall Street in its frenzy to bid up the prices of a large number of companies in a new industry, even if the vast majority of them will not prove to be solid long-term investments. That is precisely what is occurring right now with the stocks of electric car manufacturers. Tesla, the company that serves as the poster child for electric car stocks, is an excellent example. The corporation has played a very crucial role in the development of the EV sector, there's no doubt about it. But its current market valuation is around $930 billion. Ford and General Motors have a market capitalization of around $80 billion. To imagine that Tesla's company is really worth 11 to 12 times as much as Ford and GM's valuations is difficult to comprehend. Even if you made a long-term investment in traditional auto equities from the beginning of 2000, your returns would have been minimal. Based on their current market capitalizations, General Motors, Ford, and Volkswagen all have underperformed the market, and you can acquire all three companies for less than $280 billion. In spite of the fact that electric vehicles have entered the competition late, traditional automakers' stock values have remained relatively low in comparison to previous levels. This is due to the fact that the industry has historically seen booms and busts. On the EV side, Tesla is a well-established manufacturer, while businesses such as Lucid are still in the early stages of mass manufacturing, and many others are just now beginning to scale up their operations in a significant manner. In other words, the market believes that the economics of producing electric vehicles in the long run will be far superior than the economics of the conventional automobile business during the previous century. However, market cap isn't really a good way to figure out how much something's worth. Because of this, it's critical to keep in mind that most of the aforementioned EV stocks aren't really earning a profit. For the most part, if you don't have profits, you won't be able to use price to earnings, the most standard valuation measure, as a benchmark. As an alternative, price to book value is considered more accurate, which compares a firm's market value to balance sheet indicators. As from the chart, all of the EV labels have been conferred higher price-to-book ratios than GM or Ford, even though they don't have anything close to the same industry position or corporate size. Another way to interpret the commanding advantage of automakers is to take into account Porter's 5 forces for the industry. Porter's 5 forces, established by Harvard University professor Michael Porter, are used to analyze a company's competitive advantage nowadays. Based on a low, medium, or high degree of significance, analysts have sketched out these 5 dynamics and how they believe the traditional auto stands into this assessment nowadays. Given the significant costs associated with designing automobiles and establishing manufacturing capacity, new entrants to the auto industry are unlikely to succeed and have been for decades. The fact that many traditional automakers are huge and have great scale gives them considerable market power, although their influence is limited. But on the other hand, buyers have the option to buy from every other car maker, which means they have significant bargaining power. Additionally, the risk of switching one brand for another is substantial. And considering the relatively narrow profit margins for manufacturers, as well as the amount of money spent on promoting automobiles, we know that there is intense competition among the rivals. The same factors are not an issue in the electric vehicle business today, in which the fundamentals are expected to be significantly better over the next several years for a variety of very important reasons. When we take a look at the same 5 variables for the EV market, we observe a far more favorable climate. There is a greater danger from new entrants now than there was in the conventional car business in the past, particularly because most of these new entrants are publicly traded and can receive funds from the stock markets very quickly. However, establishing an automobile firm from scratch is still incredibly difficult today, which is why the danger level is considered to be medium in the EV sector. But it is also obvious that the level of competition among EV producers is almost quasi, that consumers have very few substitutable alternatives due to the restricted numbers of models offered, and that purchasers have minimal bargaining power due to the limited number of mass market producers. In addition to the financial bonanza provided by government laws and tax breaks, electric vehicle businesses are profiting from the disruption of a slow-moving legacy industry. Taken together, there is a reasonable argument that the sector is not in fact experiencing a bubble, but rather is just a mirror of what the automobile industry looked like 50 or 60 years ago. Although the EV sector today has an edge, the market will ultimately bring the element into equilibrium, and the future EV sector will be similar to what the traditional automobile industry is now. The demand for electric vehicles will most likely increase and decrease in the same way that it does during recessions, resulting in price pressure that reduces profits. Some of that danger will come from conventional vehicle businesses themselves, but some of the rivalry in the marketplace will be between EV manufacturers themselves. I'm curious to know what you think about the electric vehicle industry. Do you believe they're experiencing a bubble? Or are they simply following in the footsteps of every other new and inventive sector that has emerged in history? Let us know what you think by leaving a comment down below. Regarding the notion that EVs are in a bubble, RV is like, what bubble? We need more electric cars in the market. That certainly supports the Porter 5 Forces analysis. That should wrap things up for today. Keep in mind that subscribing is still free and liking helps YouTube recognize your preferences. Thanks for taking the time to watch, and we look forward to seeing you in the next one.